So welcome to Dev Day. This is the first panel in stage one, Future of Crypto Treasury. Obviously, if you guys have the Converge app, you'll see we've got a ton of stuff going on throughout the day, so be sure to obviously jump into every panel that suits your needs. Without further ado, I'm going to bring up Flo, and he's going to talk about the future of crypto treasury.
Thank you. Good morning.
Oops. We can't see them.
No, we can't see you all's very bright lights, but
Yeah.
we're excited to be here. I'm excited to be with this panel to talk about the future of crypto treasury. You've got a lot of great insights and perspectives on the space. I'm Flo. I'm part of Treasury's Circle's enterprise team, and I will let the panelists introduce themselves, starting with Nathan.
Hi there, everyone. I'm Nathan McCauley, co-founder and CEO of Anchorage Digital. We are a digital asset platform that provides custody, trading, lending, and overall platform services. We have the honor of being granted the first bank charter federally within the United States, and so we operate all of our services out of a national bank.
I'm Reed Cumming. I'm the VP of Compound Treasury. Compound Treasury is an institutional on-ramp powered by the Compound Protocol that provides borrowing and lending services to institutions.
Great, good morning. I'm Miles Pacini. I'm the co-founder and CEO of FV Bank. We're a bank and a trust company. We custody digital assets, and we're based out of Puerto Rico.
Hi, I'm Chris Duffus. I'm the founder and CEO of Phone Bank. We're not a bank, but we do provide an on-ramp to Web3, targeting mobile-first cash-based economies using prepaid airtime as a currency.
Excellent, thank you. So as we get started, let's set the stage for the types of organizations that are looking at crypto treasury. So if you all could just give us some insights on your clients and what types of services they're looking for, just kind of paint the picture for how you are kind of engaging in this ecosystem.
Yeah. I'll start maybe, and one of the kind of interesting dichotomies of thinking about crypto treasury is that at Anchorage we serve many different kinds of clients, but in particular for treasuries, two very different kinds of clients. So one of them you might think of as a crypto protocol. So for example, a DeFi protocol has their labs team. They might hold a bunch of their treasury inside of Anchorage. That looks like their native token and probably a mix of stable coins as well. So kind of a mix there of stable coins and their own native token. Filecoin Foundation, Celo, these are some examples on that side. On the other side, we've got Fortune 10 brands who are holding crypto with us. Many of the Fortune 500 companies who are holding, say, Bitcoin on their balance sheet, holding ETH on their balance sheet, having ETH receivables because they're running NFT projects. Any of these kinds of folks end up having treasury needs around receiving of Ethereum or Bitcoin and liquidation of those services. And so we have as traditional as you could possibly come and as kind of crypto native as you could possibly come. And the needs in many cases end up lining up very closely with each other. So it ends up being interesting.
At Compound Treasury, it's a little similar. Kind of have two axes our customers really kind of split across: crypto familiarity versus investment strategy. So we have staid corporate treasurers looking for more than 100 bips on their idle cash, all the way to crypto native hedge funds really just looking to generate more liquidity for their own operations and investment strategies. So it really runs the gamut kind of across the field there of those who have no crypto familiarity, they don't even work with USDC to begin with, all the way to those that are really looking to gain leverage against their existing digital assets. So it really does kind of spread the gamut.
Yeah, I think there's kind of a common thread here of who the potential stakeholders are. For us, it's like family offices, funds, foundations, which would be like layer 1, layer 2 organizations that have treasury, and high net worth people who are either direct traders or a lot of times branches out from foundations, for example, where they have achieved individual wealth. So I think the spectrum of the types of clients is quite wide, and I think we'll continue to see that.
And I'll add to that range, a lot of our consumers or a lot of our users are primarily consumers across emerging markets. And the benefit that that we provide them in a crypto treasury is access to dollars to buy stuff, right? Whether those are e-commerce purchases or their favorite game or online retailer or Netflix, what have you, or to fund a crypto wallet, to buy Bitcoin or to participate in DeFi. And in many cases, their options are rather limited, and in many cases, binary, where they may not be able to do that. And the way I liken sort of the financial quilt that we operate in is imagine if you landed here in California from whatever state or country you're in, and there might be a better than 25% chance that your debit card or credit card might work here. Well, that's how it is in many emerging markets for the rest of the world, especially as it relates to e-commerce and Web3.
So let's take a step back and give a little bit of historical context on how things have changed. A lot has happened over the past year, even the past 6 months in digital assets and crypto markets. Like, how have the needs, what clients are looking for, changed over that period of time?
Yeah, maybe one thing that's changed is just kind of an increasing move towards what you might call institutionalization and infrastructure opportunities. So if you set out to hold a crypto treasury, say 2 years ago, you might decide, hey, I want to self-custody this in something like a Gnosis or something like that. And so essentially those teams are saying something like, fine, I'll do it myself. They really just like look at the ecosystem and say, hey, I gotta solve this myself. Increasingly, you're seeing people come in, whether that's the large public companies or even the crypto protocols, and they kind of embark on this new adventure of crypto, and they're just asking themselves, where do I hold the assets? How do I get execution for those assets? How do I get maybe yield on those assets? And they're increasingly saying, okay, regulated financial institutions, something that looks and feels and tastes, not that you can taste us necessarily, but just generally speaking, talks and quacks like a duck, then it's a duck, and they feel like they want to use something that feels very familiar to them, like a traditional financial institution. So I think that's one of the big changes. And then the kind of within that, there's kind of a second idea that has gotten a lot of prominence, say, in the last 6 months, which is that of counterparty risk. How do you know who you want to work with? How do you know what it looks like to do due diligence there? And the theme that's developing is that you want to do due diligence the same way you have previously. If you're doing due diligence against a counterparty, whether that counterparty is a centralized financial institution or it's a DeFi protocol, over the past, say, 6 to 12 months, we've seen pretty large issues with both. We've seen issues with DeFi protocols. We've seen issues with centralized counterparties. And so this whole notion of do your own research, do your due diligence, I think is one of the things that increasingly is top of mind for folks.
Couldn't agree more. I think we're definitely seeing over the past year has been less complacency. Part of that's due to kind of the new mix of clients. Like a year ago, we didn't see too many traditional institutions really actually diving in, but now, in spite of the market turmoil, they really are. And that's bringing to bear a stronger standard of risk management, a stronger standard of due diligence, really trying to understand what are the risks involved much more clearly and much more discriminatingly than I think they have historically. I think one thing that we've definitely noticed at Compound has been a shift from concern about the protocol, even though that is something that gets raised, but DeFi did do pretty well throughout the turmoil and just being resilient to market drawdowns. But it's shifted far more toward, just as you said, Nathan, counterparty risk. Who are you actually doing business with? What is the state of their balance sheet? Much more introspective than what we saw even just 6 months ago.
Yeah, I think the last 6 months there's been a shift from the hunt for yield to the hunt for safety. And I think I kind of echo what Nathan said, is that where we had customers that would be taking money out of the bank or funds out of the bank to go invest in a DeFi protocol that was generating a high yield. Now they're coming back and saying, what products do you have in the bank that would be, quote, more safe for us? They want to deal, they're becoming less risk adverse, I think, and they're looking for opportunities to deal with regulated entities. And we think that's probably the biggest opportunity going forward in treasury management and yield management is companies who have a fiduciary responsibility to manage their funds are looking for opportunities to work with regulated entities so that they have a better understanding of what their counterparty risk is.
Chris, you have a kind of, I think, a unique perspective relative to this on the stage. Like, how have things changed for you, and how are you thinking about, and your customers thinking about using digital assets and crypto?
Sure. I mean, I definitely echo all the sentiments, as a client of these types of services. For us, I think about like our primary customer from a treasury management service is our company, right? We don't expose this directly to our consumers just because it very complicated calculus and to expose them. But for us, like our primary mission and sort of what our business is predicated on is turning treasury from historically a cost center into a profit center, or optimization of cost in that. And so obviously yields have come down or on a risk-adjusted basis. So yeah, definitely interested in capital preservation. But I do think, for some of the things that we're doing, we couldn't do it without a platform like a Circle to operate at global scale in markets where there really aren't any sort of on-ramp opportunities for cryptocurrency, and for us to just move money around globally.
Awesome. Speaking of partnering with Circle, Miles, you all had some exciting news announced about using USDC. Why don't you talk about a little bit about that and kind of what led to that and the demand and some more context?
Yeah, we try to integrate blockchain technologies into the bank, which is a bit of an oxymoron for a lot of people. But we look for all of those opportunities, and we were looking at what could we do that would be impactful. We see our customers every day either buying or selling stables, and they're going through third parties to do that. So we know that costs them some basis points. That costs them at least a day and sometimes more in settlement time. And so we took the opportunity to create USDC as what we call USDC direct deposit. So now when you open a bank account with us, you get a US dollar bank account. Traditionally you would get a SWIFT, a routing, and an account number. Now you get an ERC20 address and a Matic address. And soon to be Solana address that you can raise a commercial invoice in USDC, and someone can send you USDC, and it will directly deposit to your account as dollars with no fees. So it's just like receiving an ACH or a wire into your account. And we'll take that to the next level in the next month, where when you're making an outbound payment, you're choosing ACH or wire, you'll be able to choose USDC, and you'll be able to send a beneficiary payment directly in USDC. So we call it minting and burning directly from your bank account. And we think that is a frictionless way to introduce the use of stablecoins and integrate them directly with a bank.
What are some of the, kind of picking up on this theme of more institutionalization, digging into the risk, like what are some of the questions that your clients are asking as they're wanting to use this service, and how have you kind of evolved and dealt with some of those hesitations or objections?
Well, we're not trying to kill the Fed or kill SWIFT, right? I mean, I think that's a dangerous ambition, but speed matters, right? And efficiency matters. And so if you were to take the example of receiving a payment, ACH, couple of days, can be reversed up to 90 days, a wire T+1 or 2, depending where it originates. If someone wants to receive USDC, it's almost instant after our compliance department takes a look at it. And it's non-reversible, right? So from a customer's point of view, if they're going to receive a payment in USDC, it's faster, it's cheaper, and it's certain.
Nathan Reed, could you add also some context and color on how clients have changed the types of questions they're asking, and then how you've had to change how you engage with them to address some of these more institutionalization of questions or focus on counterparty risk and risk management?
So I think the biggest one is we've leaned pretty heavily into building a product and messaging it, marketing it, and selling it as it's predictable, it's liquid, it's compliant, it's transparent. And I think we've seen kind of a shift away from a lot of concerns around the protocol or around the underlying technology to how liquid is this? How predictable is this? Am I going to get my funds back? Is the principal protected? And so we really take a lot of pains to reveal how exactly that is the case, how they can, or how our clients can in fact gain access to their funds, track it on chain, have high transparency into exactly where their funds are at any time. I think it's been the biggest concern. We still see quite a lot of questions around regulation, around how we navigate different legal hurdles, but those are less and less. We've noticed those become less and less emphasized, and it's more and more about principal protection, capital preservation. How do I ensure that my funds are not going to somehow be rehypothecated 10 times and I'm never going to be able to see them ever again?
Maybe just one that I would mention there is we've got quite a few clients now who are public companies and kind of in the NFT space. One of the things we're finding with them is that they end up with native token receivables. I was mentioning this a little bit earlier. Say, for example, they've got a bunch of Ethereum income streams coming in, and they would like to be able to sell that Ethereum as soon as they've received it, even if it hasn't showed up at our institution yet. And so we're actually setting up process and procedures for them to get kind of an implicit line of credit so they can sell the ETH that they've got that they haven't even necessarily received into Anchorage yet, because we know that they're creditworthy, we know they're good for it, they're kind of a top 10, top 20 brand in the world. And so looking at use cases like that, where it's less about kind of holding assets long, but more about managing what would typically be thought of as, say, FX risk. They're thinking of this as an FX pair. They've got receivables in Ethereum, and they want to make sure they can get out of those and back to dollars as fast as they can. So that's one interesting one that we've seen show up. And then just generally, we're seeing a big rise in desire to utilize USDC and to get yield on USDC deposits. And so we've got a lending program that we roll out to a lot of our clients, to a lot of our startup clients, and who want to use it almost as if it was like a money market fund, where they can get yield but still have liquidity so they can take it out whenever they want. That's been a very popular product, particularly for again some of those crypto protocols that we're supporting.
So let's pick up there on yield and what clients are doing with stablecoins. Like, what are they doing with stablecoins? Is it yield? Like, give us a little bit more context on that. And if each of you could comment on that, that'd be really great.
Sure. So maybe just one set of use cases that is becoming extremely popular at Anchorage is you're a 1 or 2 person group with an idea to launch a new protocol, launch some sort of a piece of crypto infrastructure, whatever the case may be. So your life cycle is you raise funds in USDC. And so many of them we're seeing that they don't even raise in dollars anymore. Like the wires that come from the venture capitalists are not wires of dollars, they're wires of USDC. So you receive USDC into your Anchorage account. You use that USDC to kind of fund your operations. The operations allow you to go build a new blockchain, build a new piece of startup infrastructure that the community uses. Maybe you pay some of your invoices with stablecoins because some of the other partners within the ecosystem utilize those. And then over time, you launch a protocol, and you launch the protocol starts to gain traction, and then maybe you start to move some of your USDC that you have into your protocol itself, if you're, say, a DeFi protocol or something like that. And so what we're seeing is just a whole host of use cases where for a segment of the population, they really like stablecoins, and they'd actually prefer everything to be in stablecoins and to never really have to deal with dollars. And what's amazing is it's possible. It is possible to live kind of fully on chain without really having to touch the traditional finance rails, and you can run really an entire business on the back of blockchain-based assets. So I think that trend is very exciting, because it's almost like an arrival moment that you really can do everything you need to do in order to run a company on blockchain infrastructure.
Reed, what's going on with yield and stable coins and especially the needs of investors with yield and stable coins?
I think earlier this year, maybe just even 6 months ago, we saw a lot of interest in just managing floats. Like, I have X amount of USDC, and it's fairly temporary, and it's going to be recycled in and out. It's like some pretty high frequency treasury management strategies put in place. But since then, we've seen more long plays, long-only funds, family offices, others who really just are holding their assets in crypto and would like to generate very predictable yield on that without any real difficulty in doing so. And that has been a bit of something we've been able to meet as a need, but it's definitely been more emphasized increasingly as simply just want a safe place to put this USDC where it can earn a yield and I can pull from it whenever I want. On the borrowing side, it's been more and more geared toward, again, those that are actually still holding long and they simply just do not want to give up their funds but would like to get a safe degree of borrowing power on it using USDC and staying on chain. So to Nathan's point, it's really less and less USD conversion anywhere. It's just staying on chain, being able to use stable coins more effectively, but in a safer context.
Yeah, I think a good panel has a bit of controversy. So the markets have shifted. Like the last 6 months have really changed. Yield went where depository accounts were more or less zero. Now you have money markets that are reaching 4% and bonds even higher. And so being a depository institution, we want to make it as frictionless as possible. If yield's in USDC, our customers should be able to move there with a click and move into a USDC product. If yield's in dollars, they should be able to move back to dollars. And so right now, I think that there's a shift in the market where a lot of our clients, excuse me, they want to be in dollar, but they want the flexibility to move back and forth into stables as quickly as possible. And that's was the motivation for us to do the USDC integration. So I think that is a driver. Also in our business, because we're depository, we see a lot of people that they're digitally native, so they hold USDC, and they're very comfortable because that actually makes more sense to them. But they have a real need to make fiat payments. So they're renting a building somewhere, they have payroll through ADP or something, and they need to make those payments in fiat. And so we see a mix, and our job is to make those frictionless between fiat and stables.
Chris, as effectively a client of these types of organizations, like how are you making sense of this yield environment, what you can do with USDC, holding in USDC versus not?
It's a great question. I mean, for us, we definitely maintain our treasury in USDC, but like where this is really relevant to our users or our consumers is they live in economies that might be experiencing inflation up to 20%, right? And where there's dollar limits, assuming that you're even banked, you can only maybe get $20 a month in terms of Forex. And so for us, we enable them to get whatever money they can and to dollarize it so they can hold it and preserve wealth, or to participate in global commerce, which they may be blocked from in their home state or an economy.
So let's pivot now a little bit to think about the future, what's coming, and how specifically some of the more traditional treasury management solutions, what lessons learned there can be applied into crypto. And Chris, given your background as CFO and other financial roles at companies, why don't you kick us off and get us started? And what are some lessons, what are some practices that you think could potentially converge into the crypto space?
Sure. I mean, I do think from a governance standpoint, there's going to be I've not seen this yet. I'm sure you have board resolutions that could add Circle to my cash management policy. That's sort of a start in terms of familiarizing this with these types of solutions, from a board standpoint. But also I think the future of programmable money is really driven about sort of what banking looks like in the latter 21st, 22nd century. And it's not going to be brick and mortars and acquiring customers with toasters and, and the like. It's going to look like a stable coin on a mobile wallet that's accessible, that makes financial services or inclusion accessible to a majority of people on this planet. And I think the other thing I hear from the panel and we're saying is there's going to be a lot more applications where these banking services are just baked into it, and it's going to be opaque to the end user.
Miles, what can, we take from, more traditional markets, crypto, kind of combining the two? What are some lessons that can be learned?
Yeah, I think, our direct experiences, and it kind of echoes what this gentleman said, was that we're now start moving into things like we introduced USDC as a deposit, like the legal, the terms and conditions, changing them so that a customer with all the consumer protection, regulations, et cetera, just developing a terms and conditions that's really straightforward. Like if you use this product, these are the risks inherent, or this is what you should expect as an end user. For example, if you send Ethereum, you're not going to get a deposit. We may not be able to recover it. So those types of educational things are great. But I think that as entities like ours and other regulated entities do this work, we're going to invite in a much greater market, especially those markets where people are very interested and they have a reason to come into these markets, meaning that they would like some more flexibility in their treasury management, but they're just not comfortable jumping onto a DeFi protocol. They don't know, there's no phone number to call, there's no support email address, there's no regulator to report fraudulent activity to, et cetera. So I think that as more of these types of activities come into regulated businesses, we open the door for a lot more companies who I'll call crypto curious. How can I get yield on a stable coin? Can I hold it in my bank account? Those types of things. And so I'm looking forward to inviting a much greater part of the economy into what we do because we're putting some guardrails, on the industry. And I think that'll be very good for all of us.
I think kind of building on those things, we talk about DeFi, we talk about CeFi, we talk about TradeFi. I think in the future, it's all just going to be finance. It's just going to be one thing. Some of it may be powered, just as Chris mentioned, where there's some opacity to where you don't realize that you're hitting a DeFi protocol in some way as a part of your high net or your high yield savings account or some other investment strategy. Increasingly, I think these things are going to be used to simply generate yield, to generate liquidity, and to make it frictionless, more efficient, safer, faster, cheaper. All these great things. But I think kind of in the immediate term, what we're going to see until we get to that world of this sort of frictionless finance is really kind of a convergence of exactly how different entities and market participants actually evaluate risk. I think there's going to be some form of standardization that will take place throughout this decade, brought in by different companies that already exist who evaluate risks kind of across different layers, whether it's protocol risk or market risk or counterparty risk. And we even see entrance of risk managers, or at least those that attempt to grade risk, like credit rating agencies and others, to really understand how to go about navigating this landscape to make it easier and easier and easier to engage with different counterparties within it.
Nathan, any thoughts on kind of traditional, what's coming?
Yeah, I mean, I think the colleagues on the panel here did a great job of talking about that. I think the entrance and Reed's kind of underselling it. The entrance of ratings agencies coming into starting to look at the kind of debt that is available within crypto. I mean, they did an incredible thing over at Compound there. So kudos, man. Really good stuff. Getting their product actually rated by a rating agency. That's the kind of stuff that will really help us truly bridge the gap and institutionalize what's going on here. And really, I think in many ways, drive a lot more adoption. There's a lot of work that has been done by the industry, but there's still kind of a few things that need to be sorted out. Custody is getting solved, counterparty risk is getting solved, a bunch of these other things are getting solved, but really kind of packaging and creating delivery mechanisms that traditional institutions are able to really come in and get involved is really kind of that last stage. And we're getting there. 4 years ago, it was kind of a blank slate in terms of stuff that need to be built. Now we're getting to kind of the last few inches where we can really start to see a lot more participation, whether it's in stablecoin yield, or kind of more broad-based investment in decentralized crypto assets like we all know and love.
So let's talk a little bit on regulation. We were talking a little bit before we got on stage about licensing, et cetera. What are some of the hesitations that clients have about using crypto for treasury due to lack of regulation? part one. And part two is what do you want to see regulators do? We've had several panels at this conference talking about regulation, the future of regulation, what could be done, CBDCs, et cetera. Like what could regulators do, and what are the hesitations that clients have about the current regulatory space? Nathan, start with you.
Sure. I think just to take, for example, kind of the most regulated institutions that we have out there and that can meaningfully buy crypto right now, I would say those are kind of like the large asset management funds. Very large asset management funds have various requirements. And then the public companies with, say, SEC reporting requirements. These two groups almost necessarily must have what's called a qualified custodian. Qualified custodian is a bank or a trust or someone else like that that's able to provide custody services. And that's just kind of the true table stakes is I need somewhere to hold this asset. And then you get to the second set of questions, which is like, how do I reconcile this? How do I account for this? What is the accounting treatment? Is this on my balance sheet? Is this off balance sheet? How do I account for the appreciation or depreciation in the asset? What is the tax treatment of yield that comes from stablecoins? What is the tax treatment of yield that comes from lending out crypto? And many of these questions, the answers are, we don't really know. We're doing our best guesses on some of them. And so there's a lot of kind of forward-leaning where a combination of industry, regulators, and those kind of forward-leaning companies that want to come in, they're really kind of trying to figure out this all together. And a myriad of best practices are emerging. So that I would say, generally speaking, there aren't necessarily blockers at this stage. In terms of regulatory clarity and just like kind of overall regulatory system here, it's increasingly complex. In America, we have about a dozen financial regulators at the national level, all of which who have I would say on one hand very thoughtful considerations, and they're kind of optimizing for a particular policy objective, and tend to be very good at that. They tend to be very good at optimizing for that particular policy objective, and there's kind of natural striations in the financial infrastructure over there. On the other side, crypto kind of cuts across all of those, and so you end up with, if you have a sufficiently complex crypto business, you probably end up with 12 federal regulators, which is it's pretty high maintenance, honestly. And so building in that, managing that complexity, just tends to be something that you have to invest in, and that's just kind of the state of things right now. I think increasingly, Washington, D.C., you saw this with Biden's executive order, they're really leaning into the fact that particularly America needs to win in crypto. So we need to win in stablecoins. We need to win in crypto infrastructure getting built here. And this is kind of an important next frontier. And there seems to be an increased understanding in Washington that we need to make sure that companies can innovate, you can build here. And I think that's the kind of the biggest thing that I would hope to see more of, is just that notion that like America needs to be able to lead on this, and our regulatory apparatus needs to serve the national interest, which is for as much of crypto as possible to get built within the states.
Reed, I saw some nodding. What's regulation? Question mark.
It's definitely one of the biggest unlocks for the whole space. Once there's some clarity on the laws, the regulations, how it's enforced, who you're supposed to go to. Do you want to go to 12 regulators, or is it just 5? It'll just make everything easier. It'll make everything clearer, safer. It'll remove a lot of the self-imposed blockers that quite a lot of larger institutions have on themselves, because they just can't take the risk. Even if it's small, the outside risk can be enormous. I think I'm always kind of heartened by this, as I spent about a decade in fintech prior to joining Compound, and the experiences that we're having in crypto are not new. Fintech has been dealing with this for 20 years. Really, the laws that we have, the regulations that we have, the tools that we have to even be compliant have never really been recreated or upgraded to the internet age. And so now we're finally at this moment where we have to do it if we really want to push our technology, our infrastructure, our ability to be competitive forward. So I think we're going to do this. I think, as Nathan alluded to, even over the past year, in spite of the market turmoil, we've seen a lot more engagement in DC that's been much more positive, not just Bitcoin bad. It's been, there are nuances and differences, and how do we actually grade this appropriately and understand how to protect different market participants. So I think we're on the right path, but it's going to take a little bit more time, and I think if we can accelerate it in any way, that would be amazing.
Go ahead, Miles.
Yeah, sure. Not to repeat a lot of the great points that were made before me, but I think, one of the things that's great is that we do have a task force working on this from many different angles. The fear that I have is that we get regulatory soup, that we have, too many cooks in the kitchen trying to make regulation, and so that could be a bad outcome for the industry. Hopefully that is not the case. But I think areas where we could really benefit the industry is clarity around, GAAP, which is the accounting side of it, IRS treatment of assets, and also things like setting standards for KYC and AML around the space. That would be very helpful. And by the way, I think that any crypto transaction originating from the US is going to be treated just like a banking transaction in the very near future. I think, terrorist AML procedures will be the first place maybe that people touch on. I also think transparency around stablecoin reserves and requirements for capital adequacy ratios and those types of things will be the first place that regulation touches on. So I think when you have those types of things in place, maybe just those four elements, institutional and consumer adoption will increase very rapidly because there'll be a lot more trust in the system, there'll be a lot more clarity, and I think that people will get more comfortable to get involved. And that's going to lead to what this gentleman said, was that all of a sudden you're going to be dealing with these protocols and products, but you're not going to know it because they're just going to become weaved into the existing infrastructure.
Chris, what are some of the areas that it would be helpful to make your business run more efficiently or more easily, where you could get some regulatory clarity or policy clarity?
Sure. Well, I sort of look at it differently in that, I agree with what everyone said, but this is a sufficiently complicated area that it might be decades before some of these things get worked out, if at all. That said, I do believe that there needs to be like some type of sandbox. Most projects fall under a certain threshold, whether that's dollars, users, risk, et cetera. And, rather than, kill something before it's born, I think if we want to be an innovative economy, we need to be able to foster innovation, much like what was done in the internet. With some of the tax holidays and so forth, until they sort of figured it out, what it really is. And so, I call it sort of the immaculate conception of decentralization, right? Like, it has to be probably centralized before it becomes decentralized. What is that bright line, right? We don't necessarily know, we don't have those tests yet, right? And that's actually a new innovation relative to like the Howey test that has been around since 1932 and so forth. And I don't know that there's been enough sort of thinking or even proof points in the market to evidence that. So start with some type of sandbox, and as long as I think there's consumer regulatory friendly sort of disclosure associated with that, create a free market around that. And if they get above that, I do think we have a lot of the governance bodies and regulators that, whether it's the, Treasury or CFP, Consumer Financial Protection Bureau, or, whatever that, the Commodities Future Trading, et cetera, or banking, the OCC, there's these different agencies that can regulate them at that point, and tools for that. But most projects, I think, fall under a certain threshold and, should, as long as they're adequately disclosing what they're doing, be able to operate.
So let's talk about kind of, in the last 5 minutes we have, like what folks should be thinking about as, Reed, as you pointed out, kind of DeFi and crypto all just becomes becomes finance. Like what should folks be thinking about? What should they be looking at as this space evolves and kind of everything just kind of converges together to just being finance and how we run treasuries?
This is the second time you said converge.
I'm just trying to slip it in there, doing great. Yeah.
No, I'll jump in to touch on that a little bit. I think, how do we converge? I think it comes down initially to just adoption, I think, as all of us have kind of alluded to in different ways. And I think we have to really hurdle over kind of the blockers to those things. And one of them is transparency and education. What are the actual risks? How do you gauge those things well? What degree of opacity is acceptable, not acceptable? And that'll, to some degree, be tailored or personalized to different risk appetites. But there still needs to be an ability to dissect those things more and more so. I think additionally is liquidity. Right now, the crypto space, while a lot of money moving in and around it, we haven't seen more real-world assets brought on-chain. USDC was amazing and really jump-started so much interest, especially around DeFi. I think we need to see that happen again with other asset classes, other types of debt, and I think that'll be really, really amazing to unlock a variety of capital markets that can use a lot of what we're building here and then generate more and more safety, more liquidity, broader and deeper. Lastly, it's absolutely going to be regulation. Regulation needing to be more clear, exactly what is acceptable, not acceptable, who you're going to be regulated by. Right now, we're kind of living in this gray zone world where all of a sudden you could just immediately get a letter that tells you need to go do a lot of things and you don't have any idea if you're supposed to or who you need to go talk to. There's just not even certainty on exactly what regulatory body you may even want to interact with or if that's a good idea to do so. So I think having more clarity there, at the very least on what the standard is to be compliant and how to go about doing that will be incredibly valuable. Those are kind of three patterns that I think we need to see before we can really start to have significant adoption and significant convergence of TradeFi, DeFi, everything.
Maybe just some quick thoughts there. I tend to describe Bitcoin and decentralized assets broadly as functionally as a gift to humanity. It's a little poetic, it's a little maybe overly optimistic, but I feel like this is a very important sociological evolution that was unlocked, and the kind of the most optimistic view of what's going on within crypto is that we can create more gifts to humanity, more global public utilities. You know, Bitcoin is a global public utility, Compound is a global public utility, DeFi protocols, a bunch of these other layer ones that are coming out. These are very, very meaningful steps forward for the evolution of how we're able to work with each other on a global scale. Why is that so important? Well, these are, I think, over the next few decades going to be some of the most important infrastructure that we have for the way that society and the world will operate. And when you talk to people that are kind of more in the traditional investment community right now, talk to people in the traditional ecosystem, they kind of show up and they're effectively saying, who the hell are these guys? They don't know what's going on. They don't know how important this is. And so as the use cases continue to develop, as we see projects like USDC and other new protocols come out, I feel that it's extremely, extremely important that we get as much of the institutional base, as much of the commercial base, as much of the retail base on Earth as possible, participating in what is going to be just a tremendous growth of this whole infrastructure. So to me, the protocols and the actual projects that are like doing real stuff on chain are the meat and the gift. And then you've got companies like us who are effectively bridges to that world and are helping to bridge the world. And what I would like to see us do even more, I think we're actually doing great jobs now. What I'd like to see us do even more is kind of assemble and say, hey, like all of us are going to work together. We're going to assemble. We're going to converge. We're going to make sure that there is good custody systems, good trading systems, good yield systems, and good on-ramps to really bring these crypto assets to everyone as much as possible. And so we are road builders, we are connectors, we are bridge builders, and I think it's an extremely, extremely important task, and it really helps to get the meat of our industry to as many people as possible.
Miles, any thoughts on it? Chris, you can have the last word.
Yeah, I'll go out on a limb on the convergence of banking and technology and give more of a product example of what I see the vision. The relationship with a depositor in a bank today is you deposit your money and the bank uses your money to make money. That's been that way for a very long time. And, I feel so blessed to be in an industry where you have technologists creating things like decentralized exchanges and DeFi protocols. And where I see the future, and this is a ways out in the future, don't want to get any regulators' hair raising up, but what we'd like to do at FE Bank is we'd like to see a future where, for example, we can be a protocol and a loan servicer, protocol operator and a loan servicer. So we create a auto lending pool. So our depositors actually are capital providers to the pool. And this time in the future, car titles are tokens, and we hold the digital collateral in custody. And so we create a situation where our clients, the depositors, can directly participate in the car loan scheme, for example. And we play a role as running the protocol, servicing the loan, holding the collateral in a digital asset format. That's really taking the convergence of what DeFi, the technology developed, but bringing it into an environment. And so I think the role of a bank will change from just taking in your deposits and doing what you like with them, within the regulation, to operating protocols and allowing people to be mortgage lenders through products, allowing them to be car lenders. And for that to happen, we need to have, title as a token in the future. And I think that will happen. And that's going to be a super exciting time, because then we really are cutting out the middleman. We're playing a different role. Yep. We're allowing, hopefully, the consumer to participate in a greater yield and a greater direct participation with financial services.
Chris, last word with you.
For us, I see the future, as part of our objective in trying to bank the next 2 billion people on this planet. And it's not going to be done in a traditional way. It can only be done with programmable money like what is provided by Circle. And as a indicator of this sort of tipping point of adoption, I'm sure attendance in the next few years of this conference will probably double, triple, quadruple as more people see the importance of this type of solution in their business model.
Great. Join me in thanking our panelists. Thank you.